Welcome to our Moments with our Investment Gurus webinar. We hope you enjoyed the discussion today. Just some housekeeping. We applied for continuous professional development or CPD points. It is important to please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of December and receive your CPD points. The CPD certificate will be mailed to you during January 2023. Please also feel free to ask questions in the Q&A section and our speakers will either answer them live or get back to you after the event. You will also find more information about the speaker under the speaker tab on the top menu bar or if you scroll down. I do hope that you enjoyed this session and find it more valuable. First up is Diotere Blanche, our Executive Head of Investment Management, who will do a brief introduction. Welcome to you and we're very pleased to have you join us today.
Good day and welcome to the next installment of our ongoing webinar series, Moments with our Investment Gurus. We're fast approaching the end of the year and like me, I'm sure most of you are all looking forward to some rest and quality family time over the coming months. Thank you for your time and attendance today. We hope you'll find the session informative and thought-provoking. I'm sure there are many of us that are keen to put 2022 behind us. It's been a year characterized by slowing global growth, persistent high and rising inflation across the globe, and geopolitical uncertainty that's had a severe impact on economies and morale. Locally, we continue to experience low growth, high unemployment, and an uncertain political landscape. Interestingly, and perhaps worryingly, we've seen that we're not alone and that even developed countries sometimes get their fiscal policies wrong, often with disastrous outcomes. Following on the back of strong returns in the previous year, this year has seen asset values decrease significantly across asset classes, with no place to hide. A tough year then for the industry and investors alike. And the next natural question is then what to expect going forward and how to approach investing in these uncertain times. First on our agenda today is our economist, Sanisha Pakrasamy, who will share her perspective on what to expect from the global economy over the coming months and years. A good starting point and backdrop for the rest of the morning's discussions. Next up, our acting CIO, Mike Atsitz, will moderate a panel discussion featuring industry experts unpacking the outlook for various asset classes. They'll also share their perspectives on how to manage portfolios through the current market conditions. Incorporating environmental, social, and governance considerations into investment process is something all investment management businesses need to consider and evolve continually. But while ESG is receiving increasing coverage and focus, how do we make this practical in the day-to-day management of portfolios? Jana van Rooyen, our responsible investing specialist, leads a panel discussion with various professionals in our business to unpack this topic further. Last but certainly not least, Mike Atsitz will be back on stage to share some closing remarks. I hope you enjoyed today's session and the insights provided by our specialist panels. Please feel free to reach out to us if you have any questions or would like to explore any of the topics covered today in more depth. Thank you.
Thanks to you for that insightful presentation. Next up, ladies and gentlemen, is our economist Sanisha Pakrasamy, who will discuss how social, political, and economic forces have undermined relatively upbeat expectations for 2022. She will also take a peek into 2023, highlighting key themes and the outlook for growth, inflation, and policy rates in the global and local environment. The virtual stage is yours, Sanisha. Please take it away.
Thank you, Mike. Many have been negatively surprised at the way this year has unfolded. A poll conducted by Ipsos at the start of the year in 33 countries around the world found that 3/4 of respondents expected 2022 to be a better year than 2021. However, social, political, and economic forces have undermined relatively upbeat expectations that were set earlier this year. While respondents had expected to see further progress being made on vaccination programs, large swaths of Africa remain unvaccinated, raising the risk of new variants of COVID-19, thus leaving a key source of uncertainty holding back the global economic recovery. Moreover, intermittent lockdowns in China partly compounded global supply chain disruptions and added yet another layer to high global inflation and slowing world demand. Secondly, while consumers anticipated nations across the globe would actively tackle climate change, coal has become the go-to alternative as Europe races to find alternatives to Russian natural gas. Thirdly, while respondents of the Ipsos survey expected a more tolerant society to emerge from the COVID-19 pandemic, chronic debt and economic mismanagement in a number of developing nations have eroded governments' ability to support the vulnerable. Moreover, cost of living pressures have resulted in widespread discontent, with citizens staging protests in advanced as well as emerging nations. And finally, while participants in the survey were looking forward to an improved global backdrop, growth expectations have continued to slide. These disappointments have filtered into financial markets. In October, the New York Times reported that even though equities have experienced a tumultuous year, this has been an even more devastating period for bonds. Although the equity market has proven to deliver solid returns over the long haul, short-term losses do happen on occasion, as is evident with this year. In fact, Vanguard notes that 25 out of the last 96 years has resulted in a loss for the United States equity market. Investment-grade bonds, on the other hand, deliver a steady income stream and typically provide a buffer against losses in the stock market. However, bond markets across the globe have also been battered so far this year. In this chart, Lombard Odier shows that there have been very few occasions in history since 1926 where US equities and US bonds have had combined negative returns. With the data available at the time of filming, 2022 has so far been an extreme year when it comes to the correlation of returns between stocks and bonds. The surge in volatility in bond markets has starkly contrasted with a more placid view in equities. Fixed income markets have been jolted by inflation fears and risks posed by more hawkish central banks. At the time of filming, volatility in the bond market, captured here by the MOVE index, which is just a measure of short-dated realized volatility in liquid fixed income instruments, has surpassed levels seen at the start of the pandemic. Measures of volatility in gilts in the United Kingdom moved even higher on the UK government's proposed plan to cut taxes without any attempt at cost savings. Fortunately, these decisions have been reversed as part of a major cabinet overhaul, largely in response to market participants demanding responsibility from fiscal authorities. Even though global stock prices have already collapsed by 25%, a level typically associated with an impending recession, market earnings estimates have yet to reveal more difficult times ahead for corporate profitability. Once the pressure for tighter financial conditions lessens, and once financial markets get a whiff of convincing inflation relief, markets could get some breathing room as they start to discount the need for interest rate cuts to support growth rather than anticipating more hikes to quell inflation. However, financial markets will likely have to wait a bit longer for more convincing developments of a sharp and sustained easing in inflation. The rise in volatility in fixed income markets has also been reflected in the World Uncertainty Index, which tracks descriptions of economic conditions by the Economist Intelligence Unit. Over the past 6 years, financial markets have had to contend with 5 major uncertain shocks. These include 1. Britain's decision to exit the European Union, 2. The US presidential election. 3. Trade tensions between the world's largest two economies being the US and China. 4. The COVID-19 pandemic. And more recently, 5. The Russia-Ukrainian war. The International Monetary Fund, or IMF, has warned that shocks like these have ushered in a new era of greater global turbulence. Higher than historic levels of uncertainty will likely continue given the increased risks of global political fragmentation. Research by the IMF suggests that periods of elevated uncertainty tend to coincide with equity market volatility and typically precede periods of subdued growth. With greater geopolitical fragmentation and polarized politics in nations like the US and Europe, these trends are likely to power higher levels of uncertainty and volatility within the coming years. Elevated geopolitical risks have accelerated the deterioration in global growth prospects. The impact of the Russia-Ukrainian war, persistent inflation, soaring cost of living pressures, an acute energy crisis in Europe, tighter global financial conditions, and a slowdown in China on the back of intermittent lockdowns have all hurt global growth prospects. The IMF notes that growth in more than a third of economies worldwide are expected to contract either this year or next. This is up from the expectation of less than 5% of economies at the start of the year. Similarly, at the start of this year, the consensus expected developed markets to grow at 2.4% in 2023. However, this projection has since faded to 0.7%. Likewise, for the emerging market composite, financial markets were looking forward to growth of 4.5% next year, but these forecasts have since slipped to 4.2%. The Organization for Economic Development and Cooperation has attributed slowing global growth to a generalized tightening in monetary policy triggered to reduce the overshoot in inflation targets across the globe. The World Bank warns that even a moderate negative shock could tip the global economy into a recession. Historically, indicators of global economic activity, such as industrial production, trade, and oil consumption, tended to slow in the 2 years preceding a global recession. For some indicators, the pace has only slowed marginally. However, for indicators such as consumer sentiment, the pace of deterioration has been much faster than what has been experienced historically. As growth forecasts for a number of countries have been revised lower for 2023, the risk of a global recession has risen. In particular, a Bloomberg survey of contributing economists predicts the probability of a recession over the next 12 months at 60% in the United States from 15% at the start of the year. Similarly, the risk for the United Kingdom has risen from 15% to 80% over the same time frame. The risk of a recession over the next year is viewed as being the most probable for Germany at 90% from less than 20% at the start of the year. While a so-called hard landing scenario should not be underestimated for the US economy, there are a number of factors that guide towards a shallower and shorter-lived dip in economic activity. Firstly, long COVID, early retirement, less migration, and even changing attitudes to work have kept unemployment rates close to multi-decade lows. Secondly, household wealth and savings remain supportive for the US consumer. Thirdly, stronger bank capital positions in comparison to the period prior to the global financial crisis have boosted financial stability. Fourthly, an improvement in central bank credibility relative to previous high inflation episodes allows for greater ease to hit central bank targets while limiting the fallout in growth. And finally, even though the housing market is faltering, we are not experiencing anything close to the 2008 episode. Intensifying economic troubles in Europe, however, point to a larger contraction for the continent. Although adjusted consumption patterns and new gas import infrastructure facilities could help to alleviate the impact of gas shortages in 2024 onwards, the gas crisis spurred by the Russian invasion of Ukraine is likely to sharply reduce growth prospects in 2023, given the burden of higher energy prices on consumers and businesses, which vary by country. The efficiency of measures put in place by the European Union will depend on the willingness of member states to coordinate supplies and to share energy. As soaring energy prices have sharply raised living costs for Europeans, governments have come under pressure to protect lower-income households. Although EU ministers are seeking joint solutions to protect citizens from rising prices, not all countries are in agreement on targeted reductions in gas usage and price caps, as individual governments face rising pressure from unhappy citizens. These rising political pressures may prevent more systematic cooperation within the European Union, particularly in light of right-leaning parties gaining prominence across the continent. Europe has not been the only continent to experience widespread social discontent due to rising food and fuel prices. With elevated price pressures posing a more serious and immediate threat to standards of living, central banks have had to place more emphasis on fighting inflation instead of propping up waning economic activity. If left unchecked, a further broadening in inflation pressures outside of just food, energy, transport, and housing could de-anchor longer-dated inflation expectations, and this could compromise central bank credibility. Ultimately, central banks would have to hike interest rates by even more, which would damage growth and employment prospects by an even larger margin. Cost of living pressures started to intensify during the pandemic. Restrictions on economic activity created supply chain disruptions, which drove up costs given the rise in demand, which could not be adequately met by the available supply of goods. Moreover, trends such as the Great Resignation led to shortages in the labor market and put upward pressure on wages, threatening a broadening out of inflationary pressures. Although inflation remains historically high, price pressures are showing signs of easing. The global supply chain crunch is finally abating, while food and fuel increases are also slowing. Moreover, excess demand appears to be fading, with retailers reporting too much inventory on hand and negative real wages curbing spending. As such, the extent to which inflation is surprising the market consensus is narrowing for both advanced and emerging economies. Favorable base effects in goods inflation and reduced pressure in global supply chains will likely take a lot of the wind out of the inflation we're experiencing right now. However, inflation in services and wages has become stickier. Even with an aggressive front-loading of interest rate tightening cycles, a turnaround to central bank targets, especially in developed economies, is likely to take some time, particularly as monetary authorities are urged to divert their attention from elevated inflation to weakening growth fundamentals. During the course of 2022, global inflation forecasts for 2023 have drifted higher, reflecting the slower than expected return to central bank targets. Central banks are approaching a peak in hawkishness, with inflation beginning to show signs of rolling over. But an actual pivot towards an easing in monetary policy is still seen to be a few quarters away, as reflected in market forecasts. Although global inflation picked up sharply after the first quarter of 2021, it rose more modestly in Asia due to healthy food harvests and fuel subsidies. Inflation in Asia, however, started to climb and broaden in 2022 after Russia's invasion of Ukraine. Nevertheless, weak domestic demand has kept a lid on core inflation. As such, inflation fears have not forced the same degree of financial market tightening in a number of Asian economies, most notably China and Japan. This has allowed for more headroom for growth-oriented policies in the region. Further growth in tourism and supply chain diversification will boost growth in a number of Asian economies. Meanwhile, a gradual loosening of zero-COVID policies, an investment in climate transition, and a front-loading of infrastructure projects is likely to fuel a recovery in China in 2023. This is expected to follow one of the country's worst projected growth performances in decades for 2022. Despite an expected recovery, we acknowledge that property market woes may spill negatively into economic growth, leaving the expected growth figure for 2023 short of Beijing's 5.5% target. Moreover, a large corporate debt overhang and the prospect of greater geopolitical fragmentation continue to pose risks to the growth trajectory for Asia. With US and Chinese policymakers determined to reduce the two countries' economic interdependence, growth and inflation risks remain. China is now the source of only 18% of total US goods imports, down from 22% since the onset of the trade war. Outside of China, emerging markets are in a more fragile state. Subdued risk sentiment has spurred significant outflows from emerging markets, resulting in higher financial stability risks. The economic impacts of the pandemic and rising food and fuel costs on the back of Russia's invasion of Ukraine have further pushed a number of vulnerable emerging economies to the fiscal brink. Higher real interest rates in the US and heightened uncertainty have propped up the US dollar. This, together with rising borrowing costs around the world, has driven up the number of emerging markets that are facing debt distress or are in actual default. Chronic debt and economic mismanagement in many developing nations have eroded governments' ability to support the vulnerable, resulting in widespread discontent and social unrest. The IMF shows that major increases in food and fuel prices tend to exacerbate inequality measures in emerging economies to a greater extent than their developed counterparts. Growing inequality in incomes has correlated strongly with the rise in political polarization in the past decade. This has fueled political instability, raised geoeconomic risks, and contributed to higher levels of uncertainty in markets. Against this backdrop of dimmer global growth, a slow grind lower in elevated inflation, and geopolitically a more fragmented world, growth in South Africa is set to moderate from an expected sub 2% in 2022 to around 1.5% in 2023. Consumers are facing a higher cost of living, fading wealth effects, and muted employment prospects. Meanwhile, businesses are constrained by softer demand, a staggered pace of economic reforms, energy shortages, logistic hurdles, and policy uncertainty. In addition, exports are set to weaken on moderating global demand. Meanwhile, inflation pressures at a headline level are expected to unwind from around 6.7% this year to above 5% next year on the back of favorable base effects and past monetary policy tightening. Though underlying measures of local inflation are likely to react with a lag given a delay in pass-through effects, we anticipate core inflation to remain well within target in the medium term. The IMF has warned that fiscal policy should remain aligned with monetary policy in the next while to ensure that authorities are able to quell inflationary pressures. While fiscal authorities locally have promised to rebuild fiscal buffers and maintain a prudent approach to expenditure, the near-term improvement in South Africa's fiscal position has largely been thanks to a commodity price boon. In our view, this fiscal bonanza has merely masked underlying fiscal imbalances that the country has failed to resolve for over a decade due to bad governance and anemic growth. Real economic stagnation forecasted in the medium term is suggestive of continued fiscal weakness ahead. The fiscal consolidation path that National Treasury has proposed, to stabilize debt in the near term is highly questionable given an optimistic revenue outlook, the exclusion of major risks in the baseline, and an implausible spending trajectory. In our view, debt levels are already high. Rising social demands and support for parastatals and financially bankrupt municipalities will only add to the challenge of stabilizing debt in South Africa. Implementing growth-enhancing reforms to activate economic opportunities for poor households and deregulating the economy to create a conducive environment for businesses to grow and absorb labor can help to shore up growth and support sustainable revenue streams. Moreover, curtailing growth in the wage bill and finding a long-term financial solution for state-owned enterprises which create economic value can stabilize government finances in the long run. Conviction in government's willingness and ability to implement unambiguous policies quickly and efficiently can further jumpstart the economy and raise market confidence. In summary, this new regime of larger tail risks, high uncertainty, and elevated volatility is expected to continue playing out in 2023. And until inflation has shown a clear downtrend, it seems likely that higher global interest rates and balance sheet reduction will continue in spite of a fragile growth backdrop. Financial markets have had a tough time this year, with significant drawdowns and high volatility, but opportunities will become even clearer once a pivot in policy to protect growth is clearly on the horizon. While sticky inflation, tighter policy, and rising recession risks point to more potential downside in 2023, we would urge investors to not attach a high importance to short-lived market falls, which could result in destructive portfolio behavior. Instead, investors should focus on the rationality of long-termism and refrain from making unnecessary changes to their portfolios. As the end of the year draws near, we want to thank you for your ongoing support. We would like to take this opportunity to wish you a well-deserved break and a prosperous year end. We look forward to engaging with you again in 2023.
Thank you, Sanisha, for a very impactful presentation. Next up is a panel discussion moderated by our Acting Chief Investment Officer, Mike Atsett, where our panel of fund managers will give you a perspective about the current and expected investment environment and how they are positioning their portfolios. Welcome to our virtual stage, Mike and panelists.
Thank you, Michael. You would have heard from Sanisha that we are living in very risky times, and there's a lot of risk in the global environment. And over the next 12 to 18 months, we really need to think very carefully about how we position portfolios and what is the best mechanisms and opportunities and risks that we need to be aware of in terms of the management of our portfolios. So today's panel discussion really unpacks some of the major factors impacting the positioning in portfolios. And with me today, I've got a very learned panel. On my left-hand side, Ian Power, the Chief Investment Officer from Truffle Asset Management. Next to Ian is another Ian Scott. He's the Head of Fixed Interest at Momentum Investments. And then next to him, Ryan Yusuf. Ryan is the co-founder, Deputy CEO, and a portfolio manager at Sentio Capital. And right on my left-hand side is Pello Manyaneng. He's the head of listed property at Momentum Investments. The best articulation of how to implement, at least at a macro view, positioning in portfolios really comes into its own in the multi-asset class portfolios. So I'm really going to start with Ian and Ryan. So Ian, if you can maybe just unpack for me briefly, what are the key risks you've seen playing out over the next 12 to 18 months? And as a consequence of that, how have you positioned your portfolios?
Thanks, Mike. I think it's been a turbulent time, I guess, is probably the first statement to make, is there's lots of change. And principally we've sort of come out of an environment where offshore markets, and particularly the US, has been quite expensive. And you've had this long period of ultra low interest rates and lots of fiscal stimulus also coming from COVID. And I think that sort of, almost laid the foundations for a misallocation of capital to the extent that it's inflated lots of asset prices. And I think that scenario has been unwinding now as rates have been going up and as the stimulus is being withdrawn from economies. So I think that, first of all, creates a background for heightened volatility because there's less liquidity in the system and the liquidity is being withdrawn. And there was, in essence, excess valuation, particularly in the US. And I think that really set the backdrop, I think, for many other markets and economies, to the extent that the US has had to now try and deal with those problems, and principally via tightening monetary policy. And I think that's really then set, the stage for all these other geographies, including SA, where we now in a position to have to respond to rising US interest rates and everything that means. So notwithstanding the cheapness, and I know we're going to talk about it a little bit later in terms of SA valuations, it's really provided a lot of chop in global markets where, you've had some big sell-offs in both bonds and equities offshore, fears about slowing global growth. And I think broadly the big global macro is probably the biggest driver at the moment for South Africa and our SA asset prices, rather than our own idiosyncratic cheapness or expensiveness. And I think that's probably the same for many other EMs and many other geographies around the world where, countries are having to respond to what the US is doing. So I think it's really been about what the US response to inflation has been, and then obviously, all the other central banks and economies are having to adjust, until such time as perhaps that tightening cycle is over. So the waters are choppy, as you said, and I think one needs to have a sensible strategy, and we certainly have been playing this quite defensive since the beginning of the year and been focusing on not losing principal. So just making sure that we don't lose capital during times like this, until such time as we feel that, the risks are starting to subside and we can sort of dial up the risk exposures in the portfolio. But it's been a challenge.
I mean, post the GFC, you had this massive wall of liquidity pushing all asset prices up. We kind of seen the reverse now, and there's massive macroeconomic factors that are driving across the board. I mean, one of the benefits of volatility is it becomes an active stock pickers environment. But as we're going through this reset of valuation, as we see more valuation revert into portfolios, the asset allocation decision making becomes at the same time more important, but also more complex. So Ryan, from your side, can you maybe share some of your views in terms of where you think the prudent positioning is, and how do you kind of pick up sort of good opportunities and a foreseeably incredibly volatile market for the next period?
100%. So I'll probably tell you this best in the story. What's effectively happening is we're having a passing storm. So visualize a passing storm. We've passed the first part of that storm. We've seen the first accident globally and in South Africa, which is rising inflation, rising bond yields, which has resulted in equity valuations coming down. We're entering a period of relative calm right now. We think we're in the eye of the storm. And very, very soon we're going to enter another period of significant volatility. And this is going to be the real big sell-off. And what you need to be doing now is because you've passed the first eye of the storm, this part of the storm requires you to be quite nimble, because markets are going to be very choppy. So I agree with that. This is what we call the bear rally kind of zone, because economies still haven't gone into a recession, especially the US, because of various reasons. You still got sound consumer balance sheets, you've got still excess savings that people are drawing down on, you've still got a very strong job market. So monetary policy has become tighter, but there's a lag effect of that monetary policy. As the lag starts to sort of work through the jobs market, works through people's savings, stretching people's balance sheets, which is what is currently happening. Eventually you're going to have the second part of the sell-off, which is going to be the recessionary-led sell-off, which is what we call the earnings-led sell-off. That's going to come. So you need to be now in your portfolio, be nimble, keep low risk in your portfolio, but not too low risk, because there are going to be opportunities in bear market rallies. Like, for example, China reopening the economy, you're going to have opportunities to make some quick cash in buying resources cheap, or buying emerging markets assets very cheap, because valuations are quite cheap outside of the US. So we agree with what Ian is saying. But ultimately, what you need to be doing in those bear market rallies is positioning your portfolios for the big sell-off, bringing down your risk in the portfolio for that big sell-off, and having lots of cash in your portfolio for that sell-off. And when that sell-off comes effectively, and that blowout really comes, that's when you redeploy your capital in opportunities that are looking very cheap. And there's going to be wonderful opportunities to actually make money when that actually comes. So be nimble for now. Pull down risk into these bear market rallies, bear market rallies for that big sell-off, and then make money when you actually start buying at the bottom effectively. That's our plan.
So one of the big challenges at the moment is we've seen good valuation in some sectors, especially ex-US, and to kind of bet the farm that we're going to have a massive sell-off in asset prices when you don't have a view in terms of how inflation's going to work out and what the central bank actions are going to be going into the future. So I do want to direct a question at you, Ian, as the bond man. The key thing that everybody's waiting for at the moment is kind of what is the impact in terms of inflation? What are central bank policies going to be going forward? Currently, we're in an interest rate rising environment, but it's causing huge pain in the system. So do the guys stick with that hawkish stance? How do you see the fixed interest landscape unfolding, and what is the impact in terms of your view from a macroeconomic perspective?
Well, Mike, it's all about the Fed, right? I mean, whichever way we want to cut it, because remember, the Fed basically sets that global rate for dollar debt, and every country out there has basically got dollar debt. And I think where we have a big departure from the 70s is the quantum of debt. So in the Volcker period, when you had high inflation, there was basically very little debt in the world. But obviously post the GFC, there's massive debts. I mean, you think about all the government debt sitting on the balance sheets of the central banks, 9 trillion for the Fed and close to 9 trillion for the ECB, and so we can go on. And you're repricing all of that debt. That's the big question, right? So what does it mean? So as much as inflation shoots up, and we know there's reasons for inflation and there's supply constraints, when you change the price of that debt, right, disinflation can happen also very quickly. And I think, we're looking at an inverted V, if you want to call it that. Everybody's now looking up this hill, and the Fed is hawkish. And as I've said a few times before, they will be hawkish because that is their mandate. But eventually they're going to start working out, and I think with the last Fed meeting, the market actually missed that whole sentence when Governor Powell basically said, look, we're getting towards the end of the rate hiking cycle, because they know at one point, as much as people say don't bet against the Fed, I always say, the Fed should not bet against the US bond market, because we'll know which one wins. And now it's now for the first time, even the inversion of the US curve, and remember 2-year, 10 years now been inverted for quite a period of time. You now get a situation where 10-year bonds are trading below 3-month basically NCDs in the US, telling you that there is a recession coming. As Rowan said, the second part of the storm is coming. So I think at some point you probably work out that the Fed will have to hike as much as they can in the latter part of 2022, because somewhere in 2023 I think market forces will basically tell them, look, you've got to cut rates. The macroeconomic forces will just be too intense on the Fed if that recession hits somewhere in the middle of 2023, and it could be global. And then the central banks will react, firstly through cutting of rates, and secondly, there might be more kiwi on the table. But all we're saying is that I think that the interest rate profile in 2023 could look a lot different than what it did in 2022, because these central banks will somehow be forced to cut rates. And we can even draw it down to a local level where the SARB is basically also saying that they're probably getting closer to the end of the rate hiking cycle, and somewhere in 2023 they're going to cut rates again.
So I mean, the key thing that we need to keep in mind is the valuation underpin. So one of the challenges you have as a portfolio manager, when the markets have come off in the developed world so strongly, and in the South African market we've seen the equity market been under a lot of pressure for a long time. So there's good foundational valuation in the system that does create opportunities in the medium to longer term. Obviously, you need kind of the central banks to change their view from an interest rate hiking, we anticipate a hold, then a cutting cycle. So I want to start unpacking the valuation perspective a little bit, both from a local and global perspective. But before we get to that, one of the asset classes that have been under considerable pressure for a long time has been the listed property sector. We've seen now that there's actually decent valuation in the listed property sector, and as markets and economies have started to reopen, there's been parts of the sector that are actually well positioned. So coming to you, Pella, from a listed property perspective, what is the trajectory you've seen, and what are the opportunities for you in the listed property space, and how have you positioned to take advantage of them?
Thanks, Mike. I think it's clearly central banks are hiking interest rates, and obviously, as my colleagues have mentioned on the floor, that will have implications on economic growth going forward. So the view that we took in probably 2020 was to position our portfolios into companies that we felt would be able to withstand the challenging economic environment that we were foreseeing. Because in 2020, we thought, coming out of 2020, the COVID environment, demand for commercial real estate will be very weak, and there'll be winners and losers out of that environment. So if we look at our step back and look at how we've positioned our portfolios, we are overweight, or we prefer companies that retail in South Africa, pockets of retail rather, let me put it that way. We've got exposure to companies that are located in that have industrial properties located in the UK and as well in South Africa, storage facilities in South Africa as well as in the UK, and in that we're also looking for companies that we think would be able to sort of generate cash flow growth by acquiring assets that are sort of not wanted by the market, old assets, spending some capex on those assets to turn them around, improve cash flows, and improve valuations. So that's where we've sort of positioned our portfolios, and we think that over the long run, we should see investors benefiting from those companies, because there's fairly strong fundamentals that are supporting those businesses going forward. But clearly that has to be at the right valuations, and where valuations are at today, we're quite comfortable, or we sort of positive that we could potentially see investors generating decent returns out of the property sector from this point onwards.
I mean, just tying on to the valuation argument, one of the biggest decisions that face all of us in the portfolio management space over the next year is kind of what we do in terms of our local global asset class mix. In February this year, the Minister of Finance announced that pension funds or institutional investors can invest up to 45% of their assets offshore, and we're partly insulated from having to implement that decision because local valuations were stacking up. As global asset prices have come down, that theme of local is getting out of the system a little bit. So just to Ian, how are you seeing the split between local and global happening over the next, and how you positioning and what you're looking for in terms of making bigger allocations offshore?
Yeah, Mike, I mean, so we have been defensive this year in terms of our overall multi-asset risk exposure, and it's come through largely being underweight offshore. So that's where we felt that there wasn't a valuation support. And I think if you look in dollar terms year to date, notwithstanding you know what markets and SA markets have done, SA has still done much better on in dollar terms. So I think the excess valuation offshore is starting to wash out, and it's probably there's a bit more to go. So I think that's probably the first thing. And there's a big gap in terms of the undervaluation of some of the SA assets versus everywhere else. So even though we've seen some relative strength so far, I think there's still a lot more to go. And I think from a portfolio construction perspective and a risk point of view, it's one thing to be able to externalize assets and diversify, but you don't want to diversify into expensive assets, because then you're sort of defeating the the whole purpose. And I mean, I would argue that SA assets today are one of the cheapest groupings of equity and fixed income assets in the world. So, if I want to play fixed income, I want to play it here.
Yeah.
I mean, it's really cheap. I mean, Ian will probably talk to some of the details and some of the specifics, but they really are attractive. And I think SA equities as well are really, really cheap. And I think that tells us that the prospective returns for our clients from these levels are actually very attractive. And all we need is for this global volatility to subside, and it will. It will subside. And you're going to see some nice returns for our clients. So I think the important thing for us at Truffle is really to observe what's priced into assets. And there's a lot of bad news that's priced into SA bonds and equities. And we have outsized positions in our multi-asset funds on those particular asset classes, and perhaps still being cautious on the offshore equity and the offshore bonds, where we think that, there's probably a little bit of more valuation unwind to happen. So, you can't call economies and you can't call markets. All you can do is observe the discounts that assets are trading versus the intrinsic values. And right now we see some significant discounts for some of these SA assets, both equities and fixed income, and we've taken some chunky positions in them.
And I think that's an important factor to bear in mind. Investing is a long-term game, and we're going through a period of resetting. So as unsettling as the markets can be at the moment, once prices come off, it sets you up for better returns prospectively. So, takeaway from this conference is, once you live through the volatile and choppy markets, understand that repricing of assets sets you up for better returns in the future. So sometimes it is a little bit about being patient and kind of riding through the storm, and definitely we're going through that context at the moment. Ryan, one philosophical question I've got for you in terms of the local global split is, as we move assets from locally to globally, and I think we can assume that by and large asset managers in South Africa are going to start moving more of their assets offshore. What are your views in terms of what that means for the structure of the South African industry, and how asset managers will need to retool themselves to continue to be relevant for our clients going forward?
Absolutely. So I think it's very crucial to understand that there are significant benefits to investing offshore for South African investors. South African assets have a very strong cyclical emerging market value kind of bias to it, and global assets provide you something that is very good offset to that SA risks that ensue. So you've got a lot of quality assets globally, you've got a lot of growth assets like tech companies overseas, that when you combine with an SA equity portfolio, SA bond portfolio, provides wonderful portfolio construction benefits to a client, improves the client's risk adjusted return. So over time you want to be targeting higher global assets in your portfolio, and we've determined an optimal allocation of about 40%. And we're currently working towards that 40% level. Completely agree with Ian in terms of SA valuations, very, very cheap. So you want to get the timing right. Obviously, SA bonds cheap, the long bond at a 5% to 6% real yield. SA equities at about 8 to 10% real yields. So those are longer term returns that are very attractive, very juicy. So you want to actually get the timing right in terms of going global. And the rand is also very weak, well above purchasing parity as well. So you want to get the timing right. Yeah. Valuations are wonderful long-term investing tools. They're not great timing tools. So you want global bond yields to peak. You want to get through this recession globally, and then allocate to those more risky assets. So you want to get the timing right. The implication is long-term, though. Once asset managers start to really seriously invest globally for South Africa, can become quite worrisome. Already liquidity is a big issue in our bond markets. We saw that in COVID when the SARB had to intervene because our bond markets became very illiquid. Yeah. You're seeing that right now in small cap and mid cap counters in the South African space, already very illiquid. It's only going to get worse. South Africa having been downgraded to junk status effectively, we're very dependent on very fickle investment flows, and they become even more fickle. So now if you lose that support base of SA fund managers who are now investing more offshore, that's going to become even more fickle. Expect more rand volatility going forward, expect more bond market volatility going forward, expect more equity market volatility going forward, and potentially some of these discounts that we talk about as fund managers and SA assets might actually be here to stay. So there's some structural element that will always keep SA assets at a discount as a result of it. So we are concerned. We think it's the right thing to move offshore. for our clients, but as a country and as an asset pool for South Africa, we are concerned.
So, I mean, it's not just us as portfolio managers that are evaluating the global opportunity set. Corporate managers also over time have been diversifying their business models. And we've seen, for example, the South African equity market, approximately 70% of earnings are global and internationalized earnings. So Pella, how are you seeing within the listed property sector or within the specific asset classes, what's the activity from a company perspective to try and also diversify their geographical exposure? And how are the companies taking advantage of that opportunity?
Yeah, Mike. So the drive towards internationalization has been sort of a theme that's been in the property space for probably the last decade, and that's been driven primarily by very weak fundamentals that we sort of found ourselves in South Africa. Just to give you a sense, I mean, I'm sure we all are aware that there's been significant amount of space that has come through in places such as Rosebank and Sentio, and that has created significant levels of excess of space in the country. So if you step back and look at the level of supply that has come through, and you sort of look at it in comparison to what the rate of growth has been in the South African economy, you've seen supply being maybe twice the amount of growth that we've seen in the country, which is obviously not sustainable. The other sort of side of the coin that has actually driven this drive towards going to offshore markets has been the cheap equity that South African REITs have actually had access to over the last couple of years, call it 2010 to probably around 2017. So that has actually driven most of the REITs to look at taking advantage of opportunities that were existent elsewhere. And you see it today when you look at the space, there's property companies that have exposure to the US, property companies that have exposure to Australia, Central Eastern Europe. So I think if you look at the REIT sector, there's quite a handful of companies that are still or have chosen to be SA domiciled companies, but a significant portion of them have offshore exposure. The number that I last looked at is that I think probably around 49% of SA REIT's balance sheet is in offshore markets. So that gives you a sense in terms of what has happened. Call it 2000 and since 2008. I think 2008 we're looking at probably 0% exposure to offshore markets. So that's been the trend. I don't think that going forward we will see this drive continuing to gain momentum as it has over the past couple of years, for simple reasons that valuations are not attractive. Capital is not as cheap as it was before, so we'll probably see a slowdown in that space.
As we start getting to the end of the discussion, I think one of the areas that we really need to touch on, the one is that in the fixed interest markets globally, we're seeing a dry up in liquidity. And one of the issues that really face us, or risks that we face over the next year, is the potential grey listing. So it's a little bit of a 50-50 whether it happens or not, but that has implications both for the attractiveness of South Africa as an investment destination, but also in your space, very much the kind of thinking around the fixed interest portfolios, and is the very juicy yields you can get in the fixed interest space at the moment enough to entice investors. So what's your take in terms of the state of play, and how you're thinking about positioning portfolios, fixed interest portfolios going forward?
As you know, Mike, I think I've been one of the cheerleaders for bonds for most of this year, probably to my own detriment a little bit. Maybe we've been a little bit early on the trade, but look, over a long period of time, if you do the stats, you know, the South African long bond yield gives you about 2.5% real, right? If you go back to 1962. At the moment, you know, when you sit at 4 and 5% real yields, those are multi-decade type real yields. So, you know, even on a nominal basis, on a real basis, South African bonds look very attractive. Our curve is probably one of the steepest curves still in EM and in the world, and we think that will flatten. So, yeah, we think there's very decent double-digit returns from bonds over the next 2 years or more. Typically, nearly in equity type space that you can get out of bonds. And that's just on the government level. I mean, if you add a little bit of credit spread on top of that, I mean, the returns become really, really juicy. yeah, we think there's good opportunities in this market, especially on the other side around funding as well, Mike. I mean, the funding of infrastructure, the funding of private debt, there's going to be a lot of opportunities. And I think it's going to be for us, the one of the bigger challenges is where we're actually going to allocate our clients' capital in terms of, we know that, there's the whole privatization of the energy sector, probably the rail sector is coming, harbours we know is probably going to be privatized in Pelo's space in terms of property. We know that there's a lot coming around the IPPs and renewable generation. So I think that's going to be the interesting challenge for the bond market, is that when you sit with government yields already at 5% real, there is going to be a cost of capital. And I think we're going to get a lot more opportunities, not specifically in the listed rated market, but what we call the private debt market. And we're very excited around what we can see and the types of returns that we can generate in that private debt market, and the type of covenants that we can negotiate for clients versus just being a taker of price in the listed rated market. So I think we're in for very exciting times over the next 3 or 5 years in the bond market, notwithstanding just valuations. I think the opportunity set with the whole privatization drive of SOEs, if we want to call it that way, we think there's going to be very interesting opportunities in the South African bond market.
And just to close out the session, so just going to go through the panelists and just kind of give your final thoughts in terms of the current landscape and what your call to action to our audience is. So Pelle, if I can start with you, how would you conclude?
Mike, I think there's been concerns around valuations on the property sector for quite some time. We think that the COVID-19 effectively catalyzed some of the risks that have been in the sector for quite some time. So what we're seeing now is a sector which we feel valuations have corrected. There are certain pockets where we still think that we still need to see some downside, but by and large we think that most of the companies are at sort of comfortable levels of valuations. Earnings growth have also troughed, so from here we think that there's at least decent growth, even though it's not going to be sort of the same level of growth that we saw the boom years of 2010, 2017. But there's decent growth going from here, notwithstanding the challenging fundamentals that we see in the sector.
And Ryan?
So valuations are looking very attractive, but don't dive in, be patient. We think there's a lot more macroeconomic risks that are going to play out. We think a recession is inevitable, globally, in particular in the US, given the amount of monetary policy tightening that we've seen. That's going to be your trigger to actually really buy into these risk assets. So stay patient, stay invested in the markets, but with a reasonable amount of cash exposure, and use any of these bear rally opportunities to actually build cash in your portfolios for the ultimate sell-off.
Yeah, I have to echo that I've been saying on videos this year, cash is not trash, and as I've said for a while now, that you actually get real rates out of cash, so you can sit on a bit of cash, but don't sit too long on cash. We think that because of the yield curve being so steep in South Africa, we think there's good opportunities. Cash gives you that firing power, so when you see those, call it those risk-off environments, you want to allocate into the yield curve. The South African yield curve looks attractive. You want to own nominal bonds, maybe you want to own a little bit of inflation protection still in this market. We think duration is cheap at the moment, and it's basically a quality product that's gone on sale. And we always say that the best opportunities are made when quality goes on sale, and we think that, as Rowan said, the recession fears are still out there, but we think a lot is already priced into the bond market, and investors will be rewarded by taking that duration position.
And Ian, your closing thoughts?
Yeah, Mike, I mean, we would say that valuation is key, and SA assets are really cheap, and there is so much bad news that is priced into both bonds and equities that we think you need to be overweight them both. We think you need to still be cautious on global equity and be slightly patient, but always remember that the market is a forward-looking machine. And a lot of the risks that we've spoken about globally, I think, are actually already priced into some of these SA assets. And the funny thing is that when markets turn and these things turn, if you think you have time to get in, you never do. You just can't do that. So you must stick to your plan. And when you see value, you increase those exposures, which we've done. and we're waiting patiently, and if we get further opportunity, we'll actually buy more and wait for those global valuations to become a lot more attractive. And I think that's going to take time. Right now, you are being paid to take the risks of holding these South African assets, and we think you should.
So just concluding from my side, I think the saying goes, may you live in interesting times, and by golly, we're living in interesting times. So the key themes for me is we're going through a reset at the moment. So as uncomfortable as volatility can be in markets, what's important is to stick to your knitting and stay the course, to stay invested with portfolio managers that are experts in their place, but are also keeping close to the market. So ultimately, we'll get through this. As markets come off, it creates great buying opportunities, and staying the course is ultimately what's really going to generate great returns for our clients going forward. So with that, I want to thank my panelists. It's always an absolute pleasure to have such an esteemed panel and to be able to share the thoughts with both the panelists and our viewers. Thank you for joining us.
Thank you, Mike and the panel. Lots of takeaway from that detailed discussion. Our responsible investment specialist Yana van Rooyen will moderate next panel discussions, and they will be discussing a practical approach to integrate environmental, social, and governance issues into investment portfolios. Yana and panelists, welcome to our virtual stage. Please take it away.
Thank you, Mike. Hi everyone, a warm welcome to all the attendees on this webinar and to our panelists today. Joining me today for this incredible discussion, we have Stanley Bishu, our Smart Beta Fund Manager from the Systematic Strategies team. Witlatsi Mutlanyane, our Head of Alternative Investments, who oversees our private equity, impact, hedge fund and unlisted credit team. Mulebueng Matsule, our fixed income credit analyst from the fixed income team. And last but not least, Lawrence Koikoi, our senior listed property fund manager from our listed property team. My name is Yana van Rooyen, the moderator for this panel discussion, and I am the responsible investment specialist at Momentum Investments. As a company, we share the same responsible investment principles, take ownership of our fiduciary duties and apply influence to work towards a more sustainable future for our clients. We follow an integrated approach to incorporating ESG in our portfolios as we deliver returns to our clients. We will unpack how this is achieved across a variety of investment capabilities. As always, we want to be practical and do what makes most sense, taking into account the nature of the different investment types. To start, let's look at fixed income. Mulebueng, as a credit analyst in the fixed income team, how do you approach sustainable investing?
Thanks, Yana. So sustainable investing considerations forms part of our credit process. We incorporate ESG considerations in our investment and decision-making process. We have an ESG scorecard that we include in our credit reports. So how this scorecard works is that it ranks any ESG risks identified in different risk buckets, with the red bucket indicating high risk, which poses material threat to the financial and operating viability of this entity or even the environment in which it operates in. In our process, we have identified instances where ESG risk was assessed as high due to governance failures in the entity. At this level, we would not participate in the specific entity's exposure going forward. Besides the scorecard, we're also actively looking for opportunities in the renewable energy sector, so thus we have placed this sector on our buy list. We also participate in ESG-linked bonds as opportunity arises.
Thank you, Mulebueng. So then, Stanley, do allow me to segue to you. When we focus on purely the listed vehicles and in particular listed equities, there are other considerations, restrictions and opportunities. From a listed equity perspective, and as a smart beta tracker fund manager, where do you bring in those ESG considerations into your investment process?
Thanks for the question, Yana. So for the index tracking funds, where the mandate is restricted, we focus on active ownership, where we do company engagements, voting at the AGM. The explicit aim for that is to influence corporate behavior. For the smart beta portfolios, where we aim to outperform the benchmark, we follow a more integrated ESG approach. The ESG philosophy and the investment philosophy of the products are aligned. They talk to one another and they're complementary. So we integrate environmental, social, and governance considerations into the key part of the investment decision-making process. The aim is to have a more integrated approach that's holistic, and it allows us to build funds that are more robust. And so we think there are 3 key ingredients to success when it comes to that, and all 3 ingredients lead to a focused approach. So the one is materiality, right? So we want to have a handful of key ESG themes, key ESG issues that are material to the company and the sector in which they operate. So that's key for the focus. The second one is thinking around the investment horizon and the potential time it would take for the ESG risks or the opportunities to materialize. The third bit would be having a systematic approach that allows you to be more consistent when you're implementing, and it also allows you to have far more discipline, right? So practically at each stage of the investment, you can integrate and incorporate ESG, right? So whether you're having your weekly meetings, whether it's the research, whether it's company analysis and scoring, or portfolio construction, you integrate and you make incremental improvements on the investment decisions. To manage expectations, you would expect to see incremental improvements that allows for a more holistic approach, but you should not expect to see any sudden, bold, or drastic actions on the part of the portfolio manager, right? So we still believe that being measured, disciplined, is still fundamental to then delivering on the investment outcomes for our clients.
Thank you, Stanley. Looking at listed property, it is also intuitively a market that presents a different opportunity set and priorities for incorporating ESG. Lawrence, how have you and your team incorporated ESG in your portfolio construction?
Thanks, Yana. So for us, it starts with our investment philosophy, which is to invest in quality companies that are reasonably priced for a long period of time. So we can't get quality if sustainability is absent. And ESG is a way of looking into sustainability of value creation. So we've developed our own proprietary models for ESG, where we're looking into assessing the long-term impact in governance, in society, and in the environment. So every Friday morning we sit with Pete. We've been blessed by Momentum to have a dedicated ESG resource internally. And there's a formalized meeting where we sit with Pete and we go through the models that we've built for all the companies in the sector. In fact, we are close to about 60% of the sector, just in terms of ESG models that we've developed internally for ourselves. So it's an evolving process.
Thank you, Lawrence. Yes, Piet van der Merwe is our governance analyst within our responsible investment team. And I know he's very fond working with you guys as a team. So the alternatives landscape once again represents a different diverse universe of opportunities to embed ESG principles. Within the unlisted space, the real nature of investments creates clearer line of sight and the ability to work closely with management. Miklatsi, as the head of alternative investments, please help us understand how your team integrate ESG.
Thank you, Yana. So the way we look at it, more or less as Lawrence explained, we look at ESG as part of sustainable investing. So imagine sustainable investing as an umbrella. And within that, then you have the toolkit, which is ESG. And then you'll have other things such as impact and so on. So in essence, I guess the way we would look at it, we say ESG serves 3 purposes within our portfolios, right? The first one, as I said, is a toolkit to identify material risks and also to identify potential liabilities, right? And the second role it plays is that it helps us enhance the investment processes within our portfolio, right? So whether that's on the analysis side, portfolio management, but it certainly makes it a much better process having ESG within there. And then the third benefit of having ESG is that it means that the decision processes around everything with our portfolios at a total level encompasses all the risks, even what would be considered non-accounting risks, such as ESG factors, for instance. So that's more or less the role that ESG plays within our portfolios. What ESG doesn't do within our portfolios is that we don't use it as a values-based judgment system, right? So the other thing that it doesn't do is that we don't use it to account for stakeholder concerns. So we don't use it, for instance, as a negative screen, right? And then thirdly, the other thing that we don't do is that we don't use ESG as just a version of a product, right? So without necessarily changing the underlying processes. So we make sure that it's fully integrated in our system and it actually is part of the investment process rather than a version along other things that we have. So that's more or less the way we would use it, almost at a principal level. However, within the different buckets of the business, so we have hedge funds, private equity, impact, we obviously use it differently. To give you an idea, within the impact space, for instance, we'll use it a lot more intensely, right? Simply because, as I explained earlier on, within the sustainable investing umbrella, you'll have ESG and alongside that you'll have impact. So in the impact space, it's more intimately involved in how we identify opportunities, in how we process opportunities, how we take them through our approval process, and how we ultimately come to the decision to either invest or to invest. It's intimately ingrained in there. We have it as part of our investment in IC process. So right along the process, it actually is part of that.
Okay, thanks so much. Regardless of the type of asset strategy that we manage as investors, our stewardship role is the golden thread that requires us to take responsible ownership. As we allocate, manage, and have oversight across the assets that we manage, our actions should lead to sustainable outcomes to our clients, the economy, and environment. It is crucial for us to be able to engage and build relationships with our investees. Lawrence, within the listed property space, are companies open for engagement?
Yes, they are, Yana. We're seeing a lot more ESG resources being allocated by companies. ESG officers are appointed, and the pleasing thing is that they are appointed at executive levels, and also at board level. Some companies are looking for ESG skilled people. And prior to COVID, there were less ESG specific meetings requested by companies, but now I think we're seeing more companies requesting ESG specific meetings over and above investment meetings. But ultimately, we think ESG strategies and investment strategies are complementing each other. Ultimately, that's probably how you drive value in the sector, by just complementing the ESG imperatives with your investment imperatives.
Thanks so much, Lawrence. Stanley, does it make sense for a listed equity smart beta tracker fund manager to use your influence to engage with companies, with company management?
That's a very good question, Yana. And there is this expectation that because a fund is index tracking and it's passive, that you don't actively engage with management and take active ownership, and the answer is undoubtedly yes. So particularly for passive funds, where you have to be in the specific company and you don't have the choice of upweighting or downweighting the companies, it's important to actively engage with management in order to create long-term sustainable creation for our shareholders. When you look globally, in the US as an example, the US equity market makes up about 63% of the total global equity market. I was reading the Financial Times yesterday, and they were saying in 2021, for the first time ever, passively managed index funds had more ownership of the US stock market than actively managed index funds, right? So that makes it far more important for you to then engage, given that you've got that amount of ownership and therefore voting power and the ability to influence corporate behavior and create value for your shareholders.
That makes sense. Thanks, Danny. Yeah, imagine all those passive managers didn't care.
Right? Yeah.
Definitely. Willoughby, from a lender perspective, your team can't go and vote at company meetings. You don't enjoy the same rights as a shareholder. From a lender perspective, what can you do to influence your investees?
So, as part of our process, should management fail to engage us on a continuous basis, we may decide not to lend further to this entity, as this may pose significant risk to us and our processes. We have had an instance where management abruptly decided to withdraw their credit rating on their listed instruments, and in this instance, we did deem this action irresponsible by management, and we decided not to continue with our long-standing relationship with this entity.
Mitlatsi, within your alternative investment team, how do you guys influence your stakeholders?
Thanks, Yana. That really depends. By that I mean that it depends on at what level you're investing, right? In some instances, we invest as a minority partner. In some instances, we've got a much more significant stake, which gives us obviously more power to be able to interact at the management level about how companies behave. And it's at that point where we're able then to influence the board composition, equity within the business, or at least fair practices within the business, diversity within the business, but only if we have significant shareholding, equity shareholding. That is not always the case. In some instances, we are a minority player, or we hold preference shares within a company, which certainly gives us much less influence in what's happening within the company. So it really does depend. Private equity, for instance, would be at a more significant participation level, where we then have more leverage to use in order to influence, whether it's at the E level, the S level, or the G level. And it's mostly at the G level where we have more influence, or at least we exercise our influence. On the impact side, our impact portfolios are only starting now, and we are investing on the equity part of impact. And the intention there is certainly to use our influence within the company to impact specifically at the environmental level, but also at the S&G side. But we are at the moment looking at the E level. And that is to say that we want to direct companies to invest, or at least to make sure that their operations are long-term focused and sustainable focused.
Thank you, Mitlatsi. With a future mindset and a focused approach, we could create positive impact. Keeping in mind our SDG commitments that we've made as an investment team, I would like us to end off by sharing what is the theme or consideration your team will be focusing on in the new year. Stanley, would you like to start?
So we're going to continue the focus we've had this year into next year in terms of climate change, thinking about carbon footprints of the various companies, carbon intensity, transition risk, and also just transition. And the second one, alongside the ESG team, will be focusing on remuneration and the KPIs of management and how those are aligned to ESG goals of the various companies.
Excellent.
Thanks.
Mitlatsi.
Yeah, from our side, we're in the fortunate position of participating in all sectors at all levels, right? So we look at agriculture industry, we look at renewables, we look at water projects. So we're participating right across. We don't focus in any specific area. So in other words, we are able then to be impactful right across. And this is the theme that we'll be carrying forward also going into the new year. As I mentioned, our impact portfolios will be very focused, though, more specifically around environmental and social factors, simply because my colleagues here are already looking at the G part, so that's already sorted. But for our side, our major focus will be on the E and the S perspective. And lastly, if I may say, the other advantage that we have is we're able to participate right across the capital structure, right? Yes. So We can invest in equity, we can invest in debt, and we can invest in other instruments in between. So we've got different levers that we use within our investee companies to be able to influence the direction of the company, the management of the company, or the composition of the governance structures of the company.
Thanks. Madam.
So, in the fixed income team, we will continue participating in ESG-linked bonds as the opportunity arises. On governance, we remain concerned about the SOEs and municipalities and their financial viability on a standalone basis. So in the new year, we will keep an eye out on various initiatives by government to make these entities financially viable on a standalone basis again.
Thanks so much. Lawrence, do you want to add on?
Yeah, so for us, governance forms the foundation of ESG, and we don't see how a company can make a long-term impact on society and environment if governance fails. But in general, we would like to see a strong theme of green buildings coming through, just given the electricity crisis that SA is facing. A lot of property companies and landlords have big enough roof space to utilize in collaboration with government just to solve that part of the country, that issue.
So true. Thank you very much for sharing your future insights and taking us through your ESG integration process and making yourselves available on this panel discussion. Thank you.
Thanks, Yana, and the incredible panel. That was such a deep dive into a practical approach to integrate environmental, social, and governance issues into our investment portfolios. And now, ladies and gentlemen, I'm pleased to welcome back Mike Atsets into our virtual stage. He will summarize and close the webinar. Thank you for joining us today.
Thanks for the intro, Mike. And thank you for attending our Investment Gurus Conference, the final one for 2022, where we looked at some of the issues facing the current global macroeconomic environment and how we position ourselves going forward. So to start with, we had Sanisha looking at some of the risks that are currently topical and that we really need to pay attention. Clearly, inflation is a problem and interest rates are a problem, and she had a whole host of other potential risk factors that are going to have profound implications in terms of how portfolios perform going forward. In the panel discussion, I spoke to some of the experts in the field and portfolio managers who really started to unpack the implications of some of these major macroeconomic themes and how they believed it was prudent to position their portfolios in the context of the current environment. Some of the key issues that came out in that was we are going through a volatile environment, but keep in mind that volatility represents both opportunities for investing, but also a resetting of the investment environment does position portfolios to have better returns into the future. So one of the key themes that came out of that panel discussion for me was that stay invested, be patient, see the current volatile environment as a transitory environment. As we get through this period of high inflation and high interest rates, ultimately valuation will start coming through. And you would have heard from the panelists that there's good valuation to be had. It's just about being patient and staying invested, because in the long run, that patient and those investments will be rewarded. Changing tack a little bit in our next panel discussion, Jana van Rooyen just spoke very practically how we view ESG and how we integrate ESG into our portfolios. And I hope that you saw in the session that we really believe in a fundamental integration of ESG. ESG is not just something we tag on. When we look at the different asset classes and opportunity sets, the portfolio managers really applied themselves and articulated how they think systematically in terms of what makes sense in integrating ESG in a portfolio and what the rationale for that is. As an example, Stanley spoke about the role of active ownership, even in a place like index tracking, where you don't potentially perceive that active ownership drives value. But ultimately, by having an active ownership engagement, you improve the quality of businesses that you invest in, and that benefits the market overall. Some of the other key themes that came through very strongly was around climate and the need for climate action, and how do you practically implement climate action into portfolio. So I hope you found the session as interesting as we have found it, and we look forward to seeing you in the future. In closing, this event qualifies for CPD points. Keep a lookout for the certificates that will be mailed to you in due course. The recording of the conference will also be hosted on our platform until the end of December. So if you do want to rewatch any of the discussions or panel or presentations, feel free to access it. And if any of your peers or colleagues were not able to attend the event, they're most welcome to also come and have a look at the conference online. As this is our final conference, I hope you have a festive season. It's been a tough year. By all accounts, 2023 is going to be another difficult year. So get your rest, be prepared, and travel safely. And I look forward to seeing you in the new year.